Hello, ladies and gentlemen, and all colleagues in the logistics world. I am very happy to be with you again after a long time. Welcome to the newest Strategic Logistics Insights podcast series episode. I hope you are still in good health and well-being. I also hope you've enjoyed the previous episodes and found them beneficial. So, if everything goes well with you and you are ready to listen to a new podcast, let me lead you to strategic logistics management. In the last episode, I addressed my thoughts regarding how we can realize logistics strategies in the real-life operations of logistics firms. However, to realize a strategy or a plan, the related program's financial aspects should be considered carefully. As Alexa von Tabo said, a good financial plan is a roadmap that shows us exactly how the choices we make today will affect our future. As it's obvious from this introduction, in this episode, I am going to summarize Chapter 10 of the Strategic Logistics Management book, which is entitled Financial Aspects of Logistics and Costs. In this section, the economic aspect of logistics for businesses, the models used to measure logistics performance, and the logistics cost items used in these models are discussed briefly in the context of performance management systems, without going into the details within the scope of financial management and cost accounting. Dear audiences, the costs of keeping up with customer demand and maintaining high customer service satisfaction can become significantly high. Surprisingly, organizations do not seem to comprehend that clearly. One reason for that is the tendency of conventional accounting systems to focus on understanding the costs associated with products instead of the costs related to the customers. However, logistics is not only a process of value creation, but also an important cost factor for enterprises, and the costs incurred to continue logistics operations must be sustained. Among these costs, inventory, warehouse, and shipping comprise a significant portion of the total cost count. There is no doubt that these costs have a major impact on the financial performance of companies, which is exactly why managers tend to assign a great deal of importance to the said costs. As mentioned in the previous chapters, despite the fact that it differs from company to company and industry to industry, logistical costs account for approximately 10 to 15% of countries' GDP in the general economy. Logistical activities and are essentially the monetary value of compromises made by corporations for the execution of their logistics operations. However, logistics activities generate costs and income by providing market presence, accessibility, space, and time utility. They positively affect profits by reducing distribution costs via consolidation of cargo and route optimization, and impact organizational income through warehousing, shipping, inventory, and other operational cost channels. That is why the fact that the decisions regarding the logistics and supply chain management framework undertaken by logistics managers have an impact on both resource usage rates as a fixed cost investment and sales through market presence, as well as profits as a standalone cost item, should not be forgotten. Logistics operations require resources such as fixed and working capital. Thus, logistics can influence the organization's balance sheet through its role in managing resources and operating revenue better. Therefore, it is not wrong to say that better logistics management would have the power to transform a firm's financial performance, because logistics is related to quite a few fundamental aspects that belong to both assets and equity capital sections in the balance sheet. Consequently, the financial perspective should not be ignored when developing logistics and supply chain strategies. Various approaches are used to calculate logistical costs. An organization's allocation of its financial resources to a certain area to conduct logistical activities can usually be studied from a microeconomic point of view. However, this process also demands strategic decisions between investments using internal or external resources, given with a macro perspective and without disregarding the company's basic competencies. These decisions are also prone to changes dictated by external macro factors, such as the legal regulations of governments and higher institutions and the general economic atmosphere. If we return to the vital point of interest, logistics costs are basically the sum of the cost of holding products in the firm's inventory and shipping costs, which refer to the movement of products when we consider organizational logistics as a system that ensures effective and efficient product flow. However, many cost items differ with the industry being supplied or served. Since basic logistical activities are interconnected and capable of influencing one another, all functions must be managed adequately in line with the respective organization's needs. That is a process that can be realized by optimizing logistics management costs. Hence, in order for companies in the logistics sector to be successful in performance management and to learn how correctly and effectively their logistics systems run, it is important that they regularly measure and monitor the costs sustained in the process as well, in addition to the customer value they create and the level of customer satisfaction. However, the costs in this field cannot be measured with a single criterion due to the multifunctional nature of logistics services. For that reason, certain performance metrics specific to the firm and the usual ones that need to be measured and monitored regularly must be identified. In this context, quantifiable and measurable states of the basic logistics principles are used. In short, these criteria must be compatible with organizational goals, encompass specific points instead of general matters, focus on measurable actions and consequences, and have their own data collection methods. The criteria and relevant measurement methods must also be reassessed as conditions vary. Many approaches and models are used to measure the effect of organizational logistics on discussed performance. The ones that stand out among these models are the Supply Chain Operations Reference Model, which is actually a supply chain management model, the Logistics Scorecard, which is derived from the well-known organizational performance measurement model Balance Scorecard, and Activity-Based Costing, which is a model that focuses on analyzing every operation in a process according to its cost structure. The SCORE model supports the industry with standards regarding the analysis, design, and change implementation aspects of 5 integrated supply chain processes capable of improving supply chain performance in businesses with a supply chain scorecard that they can utilize in all their departments in order to set and manage supply chain performance goals. Besides, one of the main functions of the model is to provide the firm with a consistent set of parameters that it can use to gauge its own performance and to compare itself in time with its competitors. Balanced scorecard, which eliminates the necessity of choosing between a single financial or operational indicator, began to be used with time as a method that considers many facets of the supply chain and that provides a balance among these facets. The Logistics Scorecard card, which is an adjusted version of the balanced scorecard that was developed especially suited to the logistics system with the aim of measuring logistical performance and adapted to supply chain performance, puts forward a performance system matching the multifunctional structure of the logistical system. As a result of the insufficiency of conventional accounting methods in areas like logistics management, which are usually employed in establishing business performance. A new and activity-based cost accounting method that incorporates forecasting necessary resources for each activity in a process and managing those activities by sorting them as individual tasks or cost items was developed. This approach, where costs are sorted in terms of the activity component, enables a better evaluation of the supply chain's performance, efficiency, and related costs. In order to correctly conduct measurements with the use of the models that were outside the scope of consideration, certain objective indicators are needed. As commonly known, the criteria used to determine how successful a business is at reaching long-term organizational goals are called key performance indicators. These performance metrics range from financial indicators concerning the whole firm to action-based indicators confined to a critical field. Key performance indicators in the logistics system are used to monitor whether logistics operations perform up to the standard required to support company strategies. Many businesses utilize different criteria for measuring logistics management performance. However, these criteria ought to be categorized as logistics comprised of many distinct functions, and a performance management system must be set in place. Dear audience, ladies and gentlemen, this is it for now. To learn more, you can apply to my strategic logistics management book or follow my podcast series by subscribing to my channels on Spotify and YouTube. Thank you for joining me on this special journey towards the land of strategic logistics management. The new episode of the podcast series will be available soon. I hope to be with you in the next episodes. Since then, goodbye.